Okay, we are live now on Facebook.
Yeah, we're live. Let's go. We can't hear you, Lynn.
Okay.
Yeah, let's go.
Good evening, everyone. As the head of the public relations pillar for the Lebanon Oil and Gas Business Network, I welcome you all to this interesting webinar about the financial model of Blocks 4 and 9, done by Mr. Johnny West, the founder of OpenOil. And at the end of this presentation, we'll have a QA session of 15 minutes maximum in order to keep the webinar organized. And Mr. Johnny, you may start.
Thanks very much, Lynn, and thank you all for coming. I may not be the messenger you were hoping for, or the bearer of particularly good news, seeing as your organization is hoping to develop Lebanon as another oil and gas producer and exporter. But you asked me to present my findings, so I will.
Okay. Mr. West, we are realistic. We are realistic people. We don't live in.
Okay.
Okay.
So I was commissioned actually by LOGI, who I would imagine you are familiar with,
yes.
The Lebanon Oil and Gas Initiative, to look at the deals done in the first bid round. And what you can see on the screen there is that is kind of section 1 of the presentation. I did look at the deals done, and those were really, the lens that they saw these things through is a lens that civil society often looks at these things with, which is, did the government get a good deal from the companies? Was it well negotiated, etc. So we have some findings there in section 1, but it was a long time coming, this project. It's been going on and off for 2 or 3 years, but in the last 2 or 3 months, as it seemed we were finally coming to publishing, it was of course impossible to ignore the very particular circumstances we're in right now, which I'm, as you can see there, I'm summarizing by Chaos 2020, and that has quite dramatic short-term and potentially long-term consequences for the Lebanese offshore. So that's section 2, and then section 3 is, well, given that, what then is the future of the offshore sector? So the basic finding, and I'm going to go through this quite quickly because I feel as though we don't have all of the data. We've only been all of this analysis is of data in public domain. I have consulted with the LPA fairly extensively, and I think I've understood, they have built a model, of course, to evaluate bids. They won't release the model, but having talked to, the creators and the guardians of that model, I think I have a reasonable understanding of how it was put together. So I would first put the qualification and say, we don't have full information. But what I would say is, based on the information that we have, and that information is comprehensive enough, I have a reasonable degree of confidence to say these were okay deals.
Okay.
Maybe not perfect, but okay. And here's, so this is a comparison chart where we are looking at the government take, and there are various ways you can compile this metric. First, I've compiled it in an undiscounted fashion, which is sometimes called NPV0. And you can see Lebanon round 1 there, kind of in the middle, perhaps a little bit below the average, but this embraces a very wide range of countries, as you can see, including those that have a very long established industry. And the other thing to say, of course, about all of these comparisons is that they're highly theoretical. There hasn't yet been a discovery. When there is a discovery, there needs to be appraisal. When there is appraisal, you have estimates of cost structures, which will be each unique per project. So these are all based on, creating generic sets of assumptions around, modeling the fiscal regime and the contract that has been signed, but against a set of generic assumptions. And the real world could move that dial from 56%. It could easily move it up 5, 6, 7, 8%, or down 5, 6, 7, 8%, based on factors we don't even know yet, and even the companies don't even know yet. So I would, everybody always wants to make this comparison. So we are, you know, it's an extremely strong client wish, and I understood from the people in the LPA also that, of course, their political masters had demanded, you know, a similar exercise. Everybody wants apples for apples comparisons. So here it is. But as I say, I do offer all of these strong health warnings to say the fact that Lebanon's in the middle there, I would say, for a first negotiation in a province which has no discoveries is okay, right? And you can't get much more precise than that on this metric alone. There's some detail about the methodology we used. I actually blended the two blocks together, seeing as they were bid at the same time to the same consortium. And then I created a matrix of different price and cost scenarios. And so that 56% figure you've just seen, 8 different scenarios, then having chopped out the ones which were never going to be commercially viable because, you know, the company would never go ahead with development. So that's undiscounted, and then an alternative version of the same metric is often to use a 10% discount. Government take always goes up when you use a discount, again, for technical reasons, which I will leave for now, seeing as we want to breeze through. I'm happy to discuss in Q&A if anyone's interested. And here again, you can see Lebanon is in the middle of the pack, and it seems reasonable. And this especially seems reasonable because the prospectivity is around gas. So I would still add the qualification that we don't know because, as I said, we don't have full access to geological data. So it's not a conclusion I can have 100% confidence in, but a reasonably high degree of confidence that it looks to be an okay deal. There's no smoking gun. Okay, so this was the result of the first kind of set of analysis, which are the kinds of issues, as you can imagine, preoccupies activists and civil society quite a lot. You will have seen some slightly different figures which were published by the government, and they didn't publish the basis on which they compiled the metric. When I talked to the LPA, I got some more technical detail. They used a discount rate of 5%, and they used real rather than nominal dollar terms. We then shadow modeled their results. We're still 4 to 5% off their results, but again, because these are against purely speculative economics, that is not a difference which I consider to be material. So, or even if our figures are 4 to 5% different using exactly the same discount rates as the LPA did, I'm not troubled by that in terms of it driving towards a fundamentally different conclusion than what they did. That, I mean, that is, that's the government take question. Now we get to, well, there were different terms between the two blocks. How does that play out? And you can see here a chart. This is an assumption that fields might be developed using LNG, which creates a quite distinct revenue profile compared to a pipeline. And you can see that Block 4 has higher revenues than Block 9, which would, of course, match what we know about the public terms, that the cost recovery ceiling is lower in Block 4 than in Block 9. The amount of sales revenue that an investor is allowed to recoup early in the project, where they're trying to recoup capital investment, is lower, is capped at a lower threshold of sales in Block 4. So there's more profit oil available for profit share.
But the difference is not that much, I think.
The difference is not that much, which is why you can see that's the difference between those two in the early stages of the project.
Okay.
And those are those very small differences between the blue and the red lines. That's the difference between a 60% cost recovery and 65% cost recovery. And then you can see at the back end of a project, you've got a very large difference. And that's because of the different profit split ratios agreed in the two blocks. In block 9, you've got profit split for the government in both blocks starting at 30%. In block 9, it rises to a maximum ceiling of 40, whereas in block 4, it rises to a maximum ceiling of 55. And that's why your revenue split is kind of significantly different in the back end of the project there for block 4. And then you've got this very weird crossover period where for 1 year or 2 years, I can't remember, block 9 does actually earn more than block 4. But that's actually the interaction of those two terms. Because block 9 has higher cost recovery for the investor, it means that they recover all of their capital costs 1 or 2 years earlier, and therefore the profit split ratio starts to move off its starting block of 30% 1 or 2 years earlier for the government in block 9 than it does in block 4. So if those two blocks were developed simultaneously, then there would be this weird crossover period of 1 or 2 years, which you see right there in the middle, where the profit split in block 9 has moved off 30%. Even if it's only going to rise to 40%, that still creates greater revenues for the government in those years, those 1 or 2 years. And then block 4 also covers its capital costs. Then it moves up its profit share ratio, and it's moving up faster than block 9. So it overtakes again. And you've got this big fat difference between them on the back end of the project. So you see here, I mean, the differences in the two biddable terms showing perfectly in the kind of profile of revenues to government. I was asked, what were these differences normal and reasonable, the differences in the negotiated terms? And they're certainly normal. It's certainly normal to see differences of that order between two blocks in the same bid round.
What is the,
sorry
to cut you. What is my question? Why is it that there is such a difference in
well, it's not in fact a tremendously big difference.
I know.
But there could be all kinds of reasons. I mean, the biggest generically the biggest reason could be a different assessment of prospectivity. Okay. The companies have already paid over $50 million to acquire geological data. And, it may simply be that they estimate there's a far higher likelihood of finding stuff in block 4 than in block 9. And you are always in a risk-reward ratio, right? So if you figure the probability of finding stuff is greater, you're prepared to offer better fiscal terms to the government to bid higher. Whereas if you think the probability of finding something is lower, you may still proceed with a bid, but you will want to then hedge by offering lower fiscal terms. That's generically the biggest reason. There's a possible specific difference also relating to the fact that block 9 has a slice of it, which is essentially involved in the maritime dispute with Israel. A big slice of that crosses the line between Lebanon's interpretation of where the maritime border should be and Israel's, and that therefore represents for the investor, without taking a position about who's right or wrong about the border issue, which I certainly wouldn't want to do, but from a purely commercial perspective, the investor then looks at that and then says that's a higher political risk.
Okay. So this is why the company wants to take as much as possible from the cost oil, I think.
Then not just cost oil, but in general terms, if you think you're exposed to higher risk, then you're going to seek higher reward to balance the higher risk. And the higher reward, lots of aspects of reward you can't control, like you can't control future price. You may not even be able to control costs if you want to get the oil out of the ground. I mean, of course, there are more efficient companies and less efficient companies. One thing you can control clearly at the negotiation stage is the terms you bid. So if you perceive higher risk for any reason, and I'm just speculating about what those reasons could be, I'm just saying it's very normal to have differences of this order between two different blocks in the same round for those possible reasons. I don't know if those are the actual reasons in this case, but whatever the reasons are, the logic then works that you perceive higher risk, therefore you seek higher reward. In terms of negotiations with the government, that the seeking higher reward translates into offering lower tax terms. You see, it's quite straightforward. So again, without knowing all of the inside information, it looks normal and there's no reason to suspect anything. I would put it like that. There's simply no data or evidence to suggest that this is abnormal or done wrong or badly. That shows you that the mix of revenue streams to the government is stable over a quite wide range of profitability scenarios, with very low prices, such as in fact we have now. You would see the blue contribution of royalties being higher as a proportion of government revenues, but you very quickly get to roughly the same proportion of contribution of revenues between royalties, profit splits, corporate income tax, and other things. So those were the initial sets of considerations. Now let's move through to where we are now, which is a perfect storm. This is, I pulled this graph before COVID. You will see that the last data point there is February, which is before the impact of COVID-19. And these represent the three big regional gas markets. And you see a total collapse of the differentials between the Asian market, which has traditionally been right there at the top, and the European market in the middle, which of course is the potential export market for Lebanon, overwhelmingly, collapsing and converging with the US before COVID-19. COVID-19 will have exacerbated that in a way that creates severe issues around commercial viability for any new project. The Egyptians have been trying to market gas at around $5 per million BTU, which is, you can tell, well above all of those markets now. Any lower than that, and they're actually taking operating losses, and they obviously can't find any takers. Why? Well, there's big structural oversupply in the global LNG markets. So it looks as though, it's too early to be sure about this, but it looks as though there's enough growth in LNG going into gas, and of course LNG is portable, that we could be seeing the beginning of the creation of a global LNG market and the end of the defining feature of gas markets, which has been that you've got these three very distinct regional markets. It's too early to be definitive about that, but it's possible. And one of the biggest reasons is the structural oversupply. So it's true that in the energy mix, all of the great and good of international policy making predict a rise in gas demand in the energy mix and a rise in LNG within gas. So, potential rise in demand of 6 to 7% a year. However, the rise in supply, which is already programmed in projects that are, now producing or where the capital investment has been invested, the FID has gone ahead, is bigger than the projected rise in demand. Okay. Roughly, we have 400 million tons a year being produced right now. There's 200 million tons, 50% programmed in projects that are now, reached the capital investment and development phase, which is higher than the expected rise in demand. So the low prices we see now, there's really no structural reason to think that they're going to go back to previous price levels anytime soon at all.
Is it a long-term issue or a
Yes,
short-term issue?
yes. I mean, these are all projects which are coming online, you know, over the next 3, 4, 5, 6, 7, 8 years. So anyone making an investment decision now, which is of course after a discovery, which if you put it in the Lebanese context, is discovery then appraisal, we know is at least 2 to 3 years away.
Okay.
Because even if you had a discovery in the next well scheduled to be drilled, you'd have 2 or 3 years of appraisal and you wouldn't reach a final investment decision until, let's say, 2023 earliest. This 200 million tons, which is Qatar, which is expansions from Australia, which is, you know, and a lot of it going straight into the Asian market, which is the highest, has been the highest value market. There's a structural price issue. And then if you look at the specifics of Europe, the geopolitics, so the traditional dream, if I can put it like that, is pipeline. The economics of LNG play completely differently to pipeline. Other things being equal, pipeline is way more profitable in commercial terms because you can produce a lot of gas a lot earlier in the lifetime of the project, and time is money, so you achieve, with the same amount of resource and the same amount of investment, you would achieve a much higher rate of return because your revenues are much more front-loaded with a pipeline. But where's the pipeline going? So in the case of Lebanon, it's always been Europe. Well, in terms of the East Med, the geopolitics got harder in the last 12 months. I mean, so hard that it just doesn't look at all realistic. That's, let's say, the start of the pipeline, because Turkey has asserted new maritime borders, which now create a direct maritime border with Libya, which is now a client state of Turkey. I mean, there are Turkish troops in Libya, and it's specifically asserted, therefore, the right of itself in Libya, its client state, to have a veto over any new pipeline going to Europe. And of course, you have the announcement of the East Med pipeline heads of agreement signed by the governments of Greece, Cyprus, and Israel. That's probably just talk, because pipeline politics is nearly always talk. I mean, this is what happens everywhere. But the combination of those things means, you know, a pipeline setting out from Lebanese waters is massively difficult. I mean, more difficult than it has been, for factors which don't seem likely to undo themselves anytime soon. There isn't going to be any political breakthrough or opening, you know, between Greece and Turkey, Cyprus and Turkey, the Arab countries and Israel. None of that's going to happen. And then the biggest thing to understand is that also in European terms, and this again is accentuated, sped up by COVID-19, the green economy policy within the EU is very real and happening very fast. And I've been, you know, attending a bunch of European energy policy seminars, and
how fast, if I may ask,
yes.
how fast the pronostics about the change from the hydrocarbon to the green?
Well, that's a complex. I mean,
yes.
that's a complex question with ranges of probability to it. But the question with regards to Lebanon, I would say, is not that question so much as, well, what then is the possibility that Europe would in the future see a need to develop increased supply of gas from the East Med region as a whole, not just Lebanon, the East Med region as a whole? And the answer to that, I really believe, is zero, for a number of reasons. The green economy is probably the biggest single thing. So even if it's long term, even if, of course, European energy system is going to remain fossil fuel dependent in its majority for at least a decade to come, maybe 15, 20 years to come, still that is the biggest movement. I mean, I'm sitting in Germany where there are moments now where renewables are the largest single contributor to the electricity grid, greater than any fossil fuels. And there's a very aggressive policy, as the Americans would say, to increase that. So it is long term, but it's structural and massive. But then you come back to the fact that, well, what happens in the meantime, because 10 or 15 years is still enough time to be going on with. But then that's where you come to the fact that there's already a bunch of pipelines coming into Europe from Russia, already through Turkey and Ukraine. And there is this massive oversupply in the LNG market. And Europe is extremely well supplied with LNG regasification units. They're all over, you know, Spain, the Netherlands, France, Italy, etc. Which means that even if European policy still needs to fill in energy supply while it moves towards the green economy, it's going to do that through existing pipeline arrangements and just buying on the spot market, especially when the spot market is cheap and you can lock in long-term super low price contracts from projects which are already producing. And basically this is, you know, it may be tough to hear, but I mean, what I hear quite clearly when I hear the Europeans talking amongst themselves is it ain't happening. What I hear when I hear those same experts talking in mixed forums are very diplomatic versions. It's not a, you know, I mean, it's their encoded language, but it still leaves kind of room for optimistic thinking. But that's not the discourse that you hear if you hear these guys basically talking amongst themselves. So I feel confident in saying that, you know, there just isn't going to be a pipeline to Europe. It just isn't. And that's massive in terms of what the potential future for the offshore is. So, and the last thing, of course, is, you know, generic chances of success in any wildcat exploration are 80-20 globally. That can go up or down a lot, of course, with local specific data and so on. But that's the generic situation. So let's wrap up by looking at what that then means if we say there is no pipeline to Europe. By the way, a variation of that has been, well, what about Turkey? And it's true that Turkey is a very sizable market and an energy-hungry market. But just, I haven't looked at that in depth, I have to say, but again, if you look at the geopolitics, which always come first in pipeline, how would Lebanese gas get to Turkey?
Okay, here I was waiting for this moment, Mr. West.
Yes.
Because there is a possibility of extension. Now, in theory, I'm talking. There is a possibility to extend from Lebanon through Syria through Turkey.
Of course, but
it's not that capital intensive, I think.
Well, it depends how much you have to spend guarding it from ISIS.
Okay.
I mean, which is,
but it's still,
let's call that a fixed operating cost.
Okay.
Yeah. So I don't believe that you'll get any international investor. When you say not capital intensive, I mean perhaps $1 billion, maybe less. I don't know. Maybe in the high hundreds of millions, but I would suspect more like, first of all, you've got to run it to shore. In fact, probably a much better way to go is actually running it in the sea rather than on land. But I just don't, either way, I just don't believe that you're going to get any international investor prepared to put down that much money for fixed infrastructure going through Syria. You know, and under current circumstances. I could be wrong. I mean, if you know of, but
here also there is a geopolitical play, because Syria also has an interest in that, I think.
Of course, but it's just,
so it can be cost sharing between 3 countries, maybe.
Well, okay, but that's a radical decision.
Okay.
It's a radical decision. So who's making that decision right now? Right now, people who make that decision is Total and its consortium. I mean, this is a commercial decision taken by companies, right? Okay. So if you're saying, well, it could be that governments would want to step in and do it, well, maybe. First of all, then there's the question of how that relates to what the companies would like to do, and what they're interested in is, where's their guarantee of payment, which is a big issue in terms of whether you have a gas to power project and so on. And, when you say not very capital intensive, actually running the pipeline, I mean, it's in the billions.
I know.
The Lebanese state is bankrupt.
I know.
The Syrian state, well, I don't know, I haven't looked at Syrian finances recently, but it's just hard to believe that, they've got $1 billion to spare on putting down a pipeline, which then has to be protected against everything for decades. And so I don't know. I mean, but in terms of international investors, people who are looking at this as a pure commercial investment, I just don't believe that you're getting an international investor prepared to invest in huge fixed infrastructure running through Syria, either by land or by water in the current circumstances. And then the other possible route is through Cypriot waters then to Turkey, but you'll never get an agreement between Cyprus and Turkey. So you've got, so this is what I mean about perhaps not being very, my views not being very welcome. But anyway,
but should we rule out?
I'd love to, if something emerged on that, I'd be fascinated by it, but it would be totally radical and extremely unexpected from many aspects.
You were saying,
who would manage that process? Because we don't think that the Lebanese or the Syrian or even the Turkish states are in a position to actively manage that process. So then, who is the commercial party that manages that process? And then, what's the nature of their commercial relationship with the states that are in some sense backing it?
Okay.
Because they'll want to see the cash up front, and so on and so on and so on.
But this is one option, to have the pipeline set up, knowing that usually pipeline would need aligned geopolitical interests and et cetera, et cetera. So the other next substitute and the best alternative for it then, from your proposition, is to benefit from our geographical location on the East Med, and benefit from actually an independent island economy, to become an independent island economy in terms of power export from sea. We can do it via ship through liquefaction facilities from our end, and regasification facilities in Europe.
Where's the market?
Exactly.
Can't we join in terms of bidding for the international market, or we're not even?
Of course, but that's where you hit $2 per million BTU. And there's no commercial viability for the companies. I would really say below $6. I've put 5 in the graphics to kind of err on the side of optimism, but I really think it's higher than that. All of their planning has certainly been 6 and above. So you're right.
You mean it's going to serve our internal demand for the local market and save us $5 billion?
Let's run ahead. You're right. You're right. I think that there is a potential export thing if you go LNG, but the LNG in current circumstances would be highly unlikely to be primarily export oriented. It would have to be a gas to power project, and then you could see, once you had such a project in place, if you did get fundamental change in the global market and specifically the European market, because you had LNG, you might be in a position to marginally export surplus. But that's roughly the order of play as I see it. Let's just run quickly. So again, in terms of civil society and the question of public finances, what this leaves you with is a kind of the offshore sector, under the most optimistic assumptions, is unlikely to make a dent in the budget deficit. We can go back over the detail. I'm anxious to finish, so there's time for questions. This graph here is built on a number of different scenarios, which are here. It assumes, say, 10 trillion cubic feet developed using LNG. LNG would have to be the way to go if you wanted any export at all, because there's no pipeline option. You could also merge that with the fact that there has been a plan in place to get LNG regasification units coming into Lebanon to, make the power generation more efficient, to address the issue, Bassam, you were talking about, of ensuring that power generation is always loss-making, and therefore you create the generator sector. But in terms of fiscal contribution, tax revenues out of any such project, representing any significant dent in either the public budget or in the debt, forget it. If you run a net present value calculation against 10 trillion cubic feet, which as soon as you start to think about gas to power, you're thinking about a cap in what you're going to produce, regardless of the size of the discovery, because there's a cap in demand in the national market. Even being optimistic with assumptions about we can convert the power grid to a gas feedstock, we can also essentially, over a period of a few years, eliminate the generator market, because the grid would then expand because it was able to work effectively, and you've got liberalization working at the same time. But some indication of that is that, your net present value to the government now over lifetime of 10 trillion cubic feet would be in the $3 to $4 billion range.
We are talking here about Block 9 only.
No,
scenario.
this is the entire sector.
The entire sector. Okay.
This is the entire sector on the assumption of 10 trillion cubic feet discovered now.
Okay.
And developed quickly.
Okay.
Going through to a gas to power solution, because we think the pipeline is out. Once you're dealing with LNG, you've got the first constraint is the maximum processing unit, maximum processing volume of your FLNG units. So if you say, well, it could be 2.5, 3 million tons a year, that would give you something like it's roughly 1 million tons per year to TCF over lifetime. So it'd be, let's say, about 10 million tons a year, gives you 10 trillion cubic feet. You're saying you're not going to produce more than that, even if you found 5 times more than this. And by the way, we've just run a similar analysis in Senegal, and we're starting to look at Mozambique, both of which have massive fields in development now. But we're coming to the same conclusion. There will definitely be some development because it's already gone ahead. But in both cases, the companies are restricting their investment to a phase 1, which represents, in Senegal, perhaps 15% of discovered proven reserves. And the economics look extremely unlikely. Certainly for oil, because there you've also got energy transition and the possibility of a structural decline in the price of oil anyway, to pick up enough that the rest will ever get produced. And Mozambique could easily be the same. They may produce 15 or 20 trillion cubic feet in the project that's already going ahead, because it's already going ahead because $15 billion has already been committed to it. They're likely to leave 100 trillion cubic feet in the ground. Okay. It's likely. So it's not a unique Lebanese story. Anyway, just to say that if you are in this world and you're with FLNG, your first cap then is what's the maximum processing power of the unit, which the companies have put in place based on a calculation of what they consider to be commercially viable, for which, of course, they also need a market. And then your second filter is, well, where are the markets? And as I said, even if you consider Europe as a potential LNG market, it's not viable right now because of price, and likely to remain not viable right now because of price, because of the structural oversupply I described before. The oversupply is 50% of current production coming online, guaranteed, locked in. You begin to get into the question of, well, what are your break-even prices? What are your development options in a gas to power scenario? And this is an extremely crude approximation. I was doing this in a hurry because we came to, this was a kind of series of realizations, having worked on one thing, realizing, okay, we've addressed that question, but that's not the real question. then having to move on to a new question and a new question and a new question. And so if you take the current Lebanese electricity demand and you add in an estimate for how much electricity is also being supplied by the generator sector, and you estimate 7 or 8% growth a year, because there's obviously rise in it. That's your blue curve there, which is assuming that you get effective power sector reform. I mean, the optimistic side of this is to say, well, because of the natural lead times of discovery, appraisal, development, you would have 5 or 6 years to get it into place, right? So you could do that. So there's economic efficiency there, no doubt, of billions of dollars a year, right? Both in terms of the general economy and also the government's position, because so much of its debt has been related to the subsidies going into Électricité du Liban. So you would have a bunch of years to do it, but you'd need an extremely ambitious and efficient power sector reform in place by the time your gas came into production. Like I say, you do have the motivation of being able to show massive efficiencies, and therefore there's something in it for a lot of people, right? I mean, you could structure it so there's something in it for capital that's interested in taking a minority stake in some flotation of Électricité du Liban, and so on and so on and so on. It's possible to conceive of those circumstances for sure, and there's genuine big economic value in it. But what I'm showing you here with this very crude picture is, if you get LNG, this is 10 trillion cubic feet. Basically, with such an LNG development, you've got 1 year ramp up, say 2026, and then you're at this kind of flat production. The reason I'm saying 10 trillion cubic feet, and it's difficult to go much higher, even if you had a bigger discovery, is that
market limitation.
Production line can't go too much higher above the actual demand. And here we're being optimistic about what the future growth of demand is as well, remember. But it can't go too much higher, because then you've basically invested in a project which doesn't reach 100% capacity for some period of time. Imagine if that, I'm sorry, I'm colorblind. Is that an orange line? You've got the blue curve and then the orange. Is that orange or green?
Yes.
Orange. Okay. So if it was 15 trillion cubic feet, then that orange line would be shooting up higher in the late 2020s. But that represents unused capacity because there's nowhere to ship it. You would hope, I mean, possibly that could then go into exports. But as I say, it's not just the low prices on the spot market now, it's the built-in structural oversupply. That's a very risky proposition, to build a massive amount of extra capacity in the hope that spot prices are going to, triple, really triple. So
I have a question, please.
Yeah.
Just a quick question. Is it feasible, and how feasible it is, if we link, let's say, to Egypt, how do you call
export facilities,
export hubs, let's say.
Yeah.
Which means our production goes to Egypt instead of seeking other, alternatives.
Yeah, I think the problem with that is Zohr, the Zohr field in Egypt.
Okay.
If there hadn't have been Zohr, Egypt would be a massive energy importer. But they are now. I mean, it's 28 trillion cubic feet, and it's pumping.
Okay.
And they expect to be able to produce more. I believe the Egyptians are a bit optimistic about how much they can export. They believe that they can export a substantial amount. I think they're going to be able to export a little bit at the margins. But
still, it's a growing market, I think.
Yeah, but they've got growth of supply. They've got growth of supply in Egyptian waters.
Okay.
I mean, that is Zohr. That's 28 trillion cubic feet. That's big. And so I don't believe so. I believe that, you know, you've got 60 trillion cubic feet come online between Zohr and the Israeli fields in the last 7 or 8 years. You know, Israel, of course, is looking to export. It faces all of those issues around the politics, you know, the bigger political issue. But there is oversupply within the region as well, if you see what I mean. Yeah, so this is why I'm saying, although it feels like a real knockdown from being able to join the Exporters Club and so on, there is certainly from just the kind of analysis from first principles on the economic value of it, a gas power project in Lebanon does represent massive value. Whether you can put everything in place to make it work is obviously a very big question with lots of, which would need lots of further research, and a lot of the answers to those questions depend on local context and politics. You know, I mean, power sector reform is horribly difficult everywhere. There are always entrenched interests, and you know, relatively little of that I would think relates to the particularities of Lebanon. I know, talking to Lebanese friends and colleagues, there's a feeling always about, you know, the communal structure of the government, sectarianism and so on, as somehow accounting for all of the problems that Lebanon has. But actually, I think, certainly in the case of the power sector, reforming the power sector, the kind of generator sector mafia, the kind of falling over grid, etc. These are problems that, you know, tons of countries have. It's not all about, you know, the particular trajectory of Lebanese culture and history, I don't think. Okay. So, well, then you get to, well, what would the consequence of that be? The major issue around even development of a gas to power scenario is that companies want to be assured that they're going to be paid. And, you know, this is a context in which, even if there's substantial reform, they've got one customer in Lebanon who is currently wholly state-owned, likely to remain majority state-owned. You know, what is their guarantee of being paid if there's a dispute between themselves and EDL? You know, what do they rank their chances of, you know, adjudication or arbitration in the Lebanese courts against a state-owned Lebanese company, etc., etc. And this is, you know, real. The companies in Egypt started turning off the pipes before Zohr, because Egypt was defaulting on, I think they got up to $15 billion of non-payments. They had a right under the contracts, as Lebanon does under your contract, to say, we're going to buy this gas, you know, the first buyer right, a domestic market obligation it's called. Egypt invoked that, but then ran up a $15 billion bill. So you've got that issue. I mean, how would you lock in those guarantees of payment? They would be likely to be bidding historically low terms in terms of a tax rate. I would encourage you to, I mean, that then becomes a very tricky calculation, because on the one hand, you know, you don't want to feel exploited by the companies. On the other hand, you actually have to recognize the different situation that you're in. I've been saying those charts I showed you at the beginning, which compare the round one against other historical deals, all of those historical deals might no longer really be the basis of comparison in any future deals as to what percentage of the tax take a government gets. Yet, so all of that's on the challenge side, yet on the other side, you get, well, this potential, you know, wouldn't it be nice to have a working power grid? There's billions of dollars of saving, therefore profit in it for someone, if you can just work the commercial relations and politics out. And very specifically with the state, because over 30 billion of the state's $80 billion is in, you know, energy subsidies. Even if it got very low direct tax take from such a project, it would still have its financial position substantially improved by no longer subsidizing the power sector. So it's not nothing. It's not the traditional paradigm, but it's not nothing.
Okay.
Anyway, that's it.
Okay. Thank you so much, Mr. West. Thank you, really thank you for your time and effort. It was truly informative.
Thank you so much, Mr. West. Truly appreciated. And now we'll open the QA session. It will be 15 minutes, okay? So anyone who has a question, please write it in the chat box in order to not make noises. Bassam, you had a question? You're writing it, I assume.
Yes. Mr. West, I just meant to ask you regarding your projections. I'm not sure if you obviously excluded all potential development of all alternatives of use of the extra surplus gas that we might get other than the gas to power solutions. Noting that we understand the major hurdles in the country, but by nature, maybe we're candidly optimistic. We do have a major need for electricity, mostly regarding the growth in in power and energy need is huge. Noting that we barely have electricity for residential and a meager industrial sector. Now, what about the need for the like a public transportation system power requirement increase? What about the development for a whole parallel economy in terms of oil and gas industry, including the development of downstream projects and industrial projects to export and get the money rather than just exporting the gas against revenue streams? Like the additional revenue from value-added industries.
That's a great question, and in fact, you've got me. I haven't modelled all of those other things. As I said, I basically came to this question about 3 weeks ago because each time we addressed a question, we realised it wasn't the most significant question to address. So we moved on, and so the graph I just showed you of the curve, but the curve is a very optimistic representation of just gas to power because, as I say, it assumes 100% conversion to gas to power, 100%, and it assumes 7% growth, and it assumes essentially eliminating the private generating section altogether. So not just what Electricité de Liban produces now, but what it does plus the entire generator sector at 7% growth a year. You're right that that's still not, in theory, the maximum cap, because you could still develop a gas as feedstock to petrochemicals and plastics. You could still develop gas into the transport sector. Each of those, but so I say two things about that even bigger range of possibilities. Is that three things I would say is that the first is that each of them would need well-coordinated, consensus-built, long-term plans to achieve each of them individually. So like let's have a petrochemicals or let's have a plastics industry. Where are the markets for that? Who's going to come in? What's the private, et cetera, et cetera. How can we ensure that we've locked in demand? That's the same with, converting significant parts of the transport sector to being gas powered. The second is that might then take you from 10 trillion cubic feet to say 15. And the third is that all future energy projects, of course, need to compete also with renewables and solar. So you're going to have to map. We are at the parity and sometimes below parity for levelized cost of solar in many parts of the world now. And that's only going to increase as time progresses. So you would then need to factor in. So number one, each such extra use, strategic use, would require, a clear and extremely well-funded strategy. Number two, that would take you maybe from 10 trillion cubic feet to 15 for all of them. And number three, you would have to make sure that that was competitive long-term, also against renewables. So again, these are possibilities certainly worth researching. I mean, the impression I came to really was that because so much of the attention had been on this traditional paradigm of let's get in the exporting club and export to Europe and so on, nobody, I haven't come across, and I suspect nobody really has fully worked out answers to all of these questions. And they're definitely questions which are worth exploring. Of course they are. So what would a gas-to-power project look like? What would the ancillary uses of gas look like? How much demand could that generate? How would you deal
downstream
with
sector, like projects?
They're definitely, of course, they're worth investigating. They absolutely are. They all offer potential value. They all have obvious challenges. I would say research is at an early stage for all of them. Yeah. Thank you.
I have a question. Say that, and this is very improbable, which means the probability to have it is extremely. I don't know how, if I want to put it into percentage. Say that we got Turkey as a buyer, and at the same time we had our internal, say, consumption, plus the capacity to export to Europe through Egypt, saying that the probability that is a scenario that the consumption of Egypt has soared rocket soared. Okay, yeah. What is the value of let's say if I want to quantify the demand, in your opinion, how much it can be in quantity, as a quantity?
Yes, as a quantity. Well, I haven't looked at the Turkish market, so I don't know, to be completely honest. The Egyptian market offhand, yeah, I just can't see what drives. I mean, the point
it's
about
very improbable, but just an idea about.
But I know, but that's a bit like saying, well, yeah, I don't know, because you, I can't answer because it you know, the question of when Egypt would need significant amounts of extra imported gas.
Okay.
Is the numbers just don't suggest it. The Egypt looks, it will be covered for gas even at an assumed 10% per year growth rate.
True.
And we know that, you know, Egypt grows. You know, Egypt is hungry for everything. It's 5 million people now and so on. But, you know, it's covered for the next decade at 10% growth a year from its own resources.
Okay.
So I'm not sure. I saw a comment just briefly coming up about China. China, of course, has massively expanded its use of LNG in the last 2 to 3 years. And as you know, when in doubt, predict rapid growth in China. I mean, that's likely to continue. But as I say, it's a global picture. And Asia is specifically oversupplied. I mean, a lot of the new projects coming in have been targeted at Asia, and although we've been talking about the spot market, of course, nobody develops gas without having locked in gas sales agreements, which are, you know, long term, 20 years, and those have already been done for some of these projects coming online in Indonesia, in Australia. So again, the question isn't whether China is going to import more gas, it's whether the terms of sales agreements are going to significantly change in favor of the supplier, and there just isn't a reason to think that they will. In Mozambique, where there is a $15 billion LNG project now in development, it looks as though, to me, this is just an early stage guess, that they're in trouble because the underlying gas sales agreement is into the Asian market, which always looks great. That's the market everybody wants to get to because the prices have been so high traditionally. And part of the reason prices were so high was that gas sales agreements there were indexed to crude oil. The reason that gas prices became low in the US and to a lesser extent Europe is that they got decoupled from prices of crude oil early, and then you got massive supply within the US, creating this permanent low price market. And so they've got a gas sales agreement with BP, but that locked them in at the time they did the deal at, say, $6 per million BTU, which they then said was super low, but we've got security of supply. But we've kind of reverse engineered the gas sales agreement. We can't see it, but there's been some charts published by the government. It's funny, you know, often people are obsessed about keeping documents confidential, but then publish results from it, which you can quite easily reverse engineer. So if you have a series of charts which shows an oil price scenario, and then another series of charts showing the gas price scenario linked to the oil price scenario, you simply feed the charts into a nice little widget on the web, which allows you to extract the data points, and then you run a regression, and you've got the gas sales agreement, more or less. So when we do that, you say, well, okay, then it's roughly $10 a barrel per million BTU, roughly, which makes sense. 2018 then was the president of Mozambique saying, well, $6 is pretty low, but we got the investment in, we got the security of the sales. It's the cornerstone of the sector. And so then we've reverse engineered the sales agreement. We think, oh, it's $10 and so on. Where does that leave them now with oil at, you know, 30, 35, you know, $3, $3.50 per million BTU. And there's simply no way that project is commercially viable at those rates, which is leading us to considerations in those projects, which are further developed, just so you're aware of the broader context, to say, yes, definitely development is going ahead, definitely, because, you know, there are ships there and stuff being built and the capital's gone in. But they're all being restricted to phase one. The companies are having financing difficulty in their project finance. And when you look at what the nature of these relationships are, you know, companies don't always go ahead. They won't stop developing a project the moment their analysis tells them that they're hitting losses, because they have some other long-term strategic considerations once they've made the investment decision. You know, market perception, the difference in profitability from what's called point forward, from now forward, ignoring my billions of dollars of sunk costs, compared to life of project economics, which is the stage Lebanon's in because there's no discovery, so no one's made any investment at all. But it looks as we're starting to investigate things like, okay, well, yes, there's a $15 billion project financing plan with Mitsubishi and Morgan Stanley and so on, but what's the penalty clause for them to walk away? Because at some stage, they're going to say, you know what, let's just pay $400 million to get out of this project finance, because we calculate that's a smaller loss than the $2 billion loss we'll run by going ahead to develop the project. That is the stage of a bunch of projects. It's still in play, but, you know, Rystad published a graph about 3 weeks ago showing the sanctioning of new projects is 95% down in 2020. And you've got to factor that there isn't going to be a bounce back which takes us back to where we were on January the 1st by December 31st this year. It's not all just short-term panic for Corona, which gets re-established. There's going to be quite a lot of long-term chaos across the global economy in many aspects. But you've also got crude oil, for example, with oil, you've got energy transition coming up, and therefore having to factor maybe long-term structural price decline. So how much could you produce before oil prices just start to drop generically as energy transition pricing kicks in? There were a set of calculations running until, let's say, March, which were, well, maybe we can produce enough out in the 2020s before the structural price decline really kicks in that we can produce a viable project. But that was with an assumption of oil now at $65, $60 a barrel, staying roughly there for 5, 6, 7 years before it starts a long-term price decline. But now the oil price has been kicked in the teeth. And even if you think it will recover from 30 to 35 to 40 to 45, even to 50, it may recover to 50, but not go back up to 60. And that's a slow recovery. And then the long-term structural price decline kicks in anyway. Very, very few projects are viable under those circumstances. Guyana, certainly. Maybe Suriname, certainly. But that's why you've got a 95% drop on sanctioning of new projects amongst the oil majors, because they're just not certain that any of these are viable.
Thank you so much, Mr. Johnny. We have 3 questions.
Okay.
I'll start with Edgar. He's saying that it was a great presentation and it has a good dose of reality between the deals of Russia, Turkey, and the other one with Israel and Egypt, Cyprus. Do you feel that Lebanon missed the boat on gas?
Well, I mean, yes is the short version of that answer, simply because if there had been a bid rounds in 2010 rather than 2020, then clearly everything would be massively different. Now, I don't know. I haven't researched the history to say, well, how much of that was, you know, bad decision making, bad policy, etc., etc., etc. I'm not in a position to comment on that, but missed the boat in the sense of, you know,
we confirm it anyways.
Right, but what would the situation have been like if 10 years ago? Yes, clearly it would have been very different.
True. Okay, we have Hassan Khalifi asking, I would like to ask about the assumptions the fiscal model is based on. Also, which of these assumptions do you consider as most volatile?
It's a great question. I mean, the most volatile is always price and the most material. I mean, it has the most fluctuation within it, and it is the most material in the sense that a small fluctuation in price has a bigger impact on other metrics than anything else, bigger than, for example, estimates around the amount of costs or anything else. So prices. The model itself is, well, is very shortly about to be published. There's a whole bunch of assumptions which have gone in there. I'll send you the link when it's up, which should be within 1 or 2 weeks. We're just waiting for the Arabic translation. But the entire model, the Excel spreadsheet, which includes a data point by data point explanation of the source or basis for compiling each input and variable. Well, I regard this as an extremely important part of responsible modeling, which weirdly enough isn't a widespread perception and in the public policy space, which is that because anyone can prove anything with a model depending on the inputs and assumptions that go in, obviously you have to state all of your assumptions and defend your assumptions and state the sources where you've got data from and so on. Obviously the contracts themselves are the source of all of the interpretation of the tax terms, and there's really no controversy or argument about that. The other big areas, of course, are price and prospectivity. What I've noticed in reading the literature around Lebanon is that there's very loose use of different categories. In technical language, resources are radically different to reserves, and there are many categories of each. So when you see some minister saying there's 25 trillion cubic feet, or no, now there's 100 trillion cubic feet, they're not using any category which anyone would ever go to the bank with. the system of classification of oil and gas resources is kind of super tight. The most widely used is the kind of Society of Petroleum Engineers in the States, widely used internationally. And before you think about what anything means commercially, you've got to understand which category of resource or reserve is somebody talking about. So all of the discussion I've seen, including from the government, has been extremely loose, mixing categories, which makes none of those estimates in public domain at all reliable. And I'd be very surprised, by the way, if the government had a reliable estimate in private either, just going by past experience. So the kind of thrust behind the question is absolutely correct. You could come to quite different conclusions if you use different assumptions and inputs. You'll be able to take a view on that when we publish the model in about 2 weeks.
Okay, great. And now we have the last question. Bassam is asking, how much do you expect the gas consumption of Lebanon will be if we invested in the infrastructure and the petrochemical industries?
Well, like I said, the graph I showed you was a very crude last-minute job to say if, a bunch of ifs around the gas to power sector, and that got us to, well, that could absorb 10 TCF. I've done no work around petrochemicals, no work around these other potential uses of gas, but just from a very ballpark understanding of how they work, where they've been deployed, I'd say it would still be very difficult to imagine all of that in total going above 15 TCF.
Okay.
Okay, thank you so much, Mr. Johnny.
Yeah.
It's truly appreciated. And it was a great presentation. We hope for future collaborations with you. And anyone has anything to say before we close this webinar?
Just to say thank you, Mr. West, for your time. Once again.
Welcome.
Thank you so much. Thank you so much.
Thank you.
Thank you. Take care. Cheers.
Bye-bye. Bye.
Bye.
Thank you.
Lean, thank you. Jamia.
Thank you.
Thank you.
Thank you everyone for attending.
Nice.
Bye-bye. Bye.
Bye. Bye.